we have been increasing our allocation to UK equities all year. Partly because the valuation case in the UK is, the FTSE 100 is trading at 9 times. It's stunning. As you said, some of those dividend yields are incredibly attractive. So yes, there are always going to be opportunities. The UK is one of them right now, not only in the traditional equity sphere, but we're also investing quite heavily in infrastructure investment trusts, for example, where the yields are also very attractive. Also, just I want to mention is that there was a screaming value in the gilt market when it was at 4.5, but it's still reasonably attractive, we think. So yes, the UK is good. There are opportunities out there. What worries me still is the US, particularly the growth sector valuations, which we still think have have a potential for quite a lot of downside still.
That's going to be disappointing news for many tech investors watching the program, given the pullback we've already seen in so many of those growth stocks. When it comes to the Fed pivot, Steve and I were discussing earlier on the show how the language, what the definition of Fed pivot actually means, has changed over the last several months. It's really been diluted from investors talking about the Fed cutting interest rates to the Fed pausing to now a Fed pivot meaning to most simply reducing the pace at which it raises interest rates. What would you rate the chances of the Fed actually delivering a proper pivot, i.e. cutting interest rates?
Zero. There's no chance of that for the next 6 months. You're right. I mean, we are at the end of the day, we are quite optimistic animals, and we keep changing our view of what pivot might mean, and the market keeps getting overexcited about, this mythical pivot. Look, it's not going to happen simply because services inflation is still accelerating. Rental inflation is still accelerating. And if you look at things like physician services, they are, they're double the annual pace that they were 2 months ago. Right? Physician services have nothing to do with commodities. They're rooted effectively in the labor market. Airfares are almost twice as expensive today as they were 2 months ago. Ironic when oil prices have actually come down. So there's lots and lots of service inflation. Clearly, Steve mentioned the JOLTS number as well. The Fed has got to make sure that this path that they've gone on ends at a destination where inflation, particularly in services, is on an irreversible downtrend. We are not anywhere close to that. So I would say at the very minimum 6 months before we see a proper pivot, but probably longer than that.
Fahad, I've been trying to book some flights for the last few weeks, and it has been extraordinary to see how high prices were. It certainly caught me by surprise, as you said, given that we have seen this pullback in fuel costs. In terms of those growth stocks and the tech stocks, what is going to be the main driver of those? I mean, you said that you think that it's not the time to get involved now. Is it earnings? Is it the Fed? What is the primary thing to watch there if you are investing in this space?
Look, all of those are going to be factors. Obviously, a big part of the reason why there has already been quite a fall is because the rates keep rising, and we know that these are long-duration assets to some degree. But look, valuations are still not particularly cheap or compelling, right, in the tech space. I mean, they're not cheap. These are still relatively expensive companies. Yes, they're much cheaper than they were at their apex, in November 2021. But they were grotesquely overvalued then with the benefit of hindsight. They're still probably quite expensive right now, and there's just downside room. There will be a confluence of factors. Probably, as you said, rates will, whenever this mythical pivot occurs, will be one, slightly more stability, and maybe generally yields go down, giving people once again, this strong impetus to buy heavy growth. But right now, we're just not there. There's a lot more attractive opportunities in the value sphere, as we've been discussing. And it'll be a while. It'll be a while still.